We're in the heart of earnings season, and that means there's a deluge of news coming out on a day-to-day basis, huge reactions on the market. One stock that really caught my eye, this is a stock that I own, it's part of the asymmetric investing portfolio, is MGM Resorts. Really great financial results released after the market closed on Wednesday, but the stock was down 13% on Thursday. So what in the world went on? There's a bunch of things. There's really no single answer. And this is what I think is so interesting about this reaction in particular. I'm going to give away the lead here. This is one of the cheapest stocks that I think there is on the market right now. Management says that they can grow cash flow by double-digit percentage points over the next few years, yet the enterprise value to EBITDA, the entire company, divided by basically a proxy for the cash flow that the company is generating, is just 4.9 times. That is extremely cheap for a gaming company. Historically, gaming companies have traded for over 10 times enterprise value to EBITDA. So why is this such an unloved stock right now? And why am I interested in potentially buying more over the next few weeks? That's what I'm going to dig into today. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. I'm going to go to the press release and just go through some of the key numbers from the quarter. You can see here record revenue, $4.3 billion for the quarter. Record Q2 MGM China adjusted property EBITDA, $294 million. So over $1 billion run rate in adjusted EBITDA being generated in Macau right now. That's an increase of 40% year over year. So things are going really well there. They are taking market share. Net income, $187 million. And consolidated adjusted EBITDA, this is a proxy for cash flow. EBITDA means you have to also pull out rent. I'll get to that in a little bit. But that was $1.2 billion. So you just annualize that, just take it times 4, $4.8 billion in EBITDA. The rent payment per year is about $1.8 billion. So that means there's about $3 billion in EBITDA, or basically cash flow, coming from the company. Not bad for a business that is currently valued at less than $12 billion. Let's go through some of the regional operations. Las Vegas Strip is obviously what MGM Resorts is known for. Net revenues of $2.2 billion. That was up a little bit from a year ago. This compares to Caesars, was down a little bit from a year ago, so things are going pretty well, at least maintaining market share. Now, one of the interesting things on the Las Vegas Strip right now is two resorts, the Mirage and Tropicana, are closing or have closed. The most meaningful for MGM is going to be the Mirage. That's going to take a significant number of rooms, entertainment options out of supply in Las Vegas. So these revenue numbers, even if demand overall in Las Vegas goes down a little bit, supply is going down a little bit. So we should maintain pretty good pricing, pretty good operations for MGM overall, given their large exposure to the Las Vegas Strip. So I think that's just an interesting note. They talked about that a little bit on the conference call. But supply is going to be constrained in Las Vegas. It's constrained overall just physically by the number of casinos. But you take one of those major casinos out of the mix there, and that's going to be good for all of the other operators in that area. Adjusted property EBITDA, $782 million, up just slightly from a year ago. Regional operations actually held up pretty well. This is one of the things that I was looking at because Caesars was pretty weak in regional operations, but net revenue, $927 million, flat from a year ago. Adjusted property EBITDA, $288 million, down slightly from $294 a year ago. I mentioned some of the China numbers a bit ago. You can see the revenue was up 37% to $1 billion, and that adjusted property EBITDA number. So we're nearing the 30% EBITDA to revenue margin number. That's kind of where you want to be for casino operations. 30 to 35% means you're operating really efficiently. Now, this is the thing that I want to highlight because this is one of the reasons that I own shares of MGM is their share repurchases. During the second quarter of 2024, the company repurchased 10 million shares of stock for an aggregate of about $413 million, so about $41 per share. They also have the ability to buy back another $1.3 billion worth of stock, so about 10% of shares outstanding. And that's where if you go to their balance sheet, there is a lot of ability to potentially buy back stock if management wants to get really aggressive with that over the next 3 to 6 months, let's say. Total liquidity, $3.7 billion. This is revolver availability. I don't necessarily think they should be borrowing money to be buying back stock, especially from a revolver. But there is $2 billion worth of cash on the balance sheet. Management says that they need to have property working capital of $500 million and another minimum cash for Their financial policy, $750 million. So there's $800 million in excess cash. Now, eventually they're going to need to fund things like the expansion in Japan. They may need to fund some of their digital operations around the world, but there is cash flow coming from the business on an ongoing basis. So it's not out of the realm of possibility that management could buy back 5 to 10% of shares outstanding just over the next quarter or so, given the excess cash that's being held on the balance sheet. So that's one of the reasons I think that the valuation and the market's reaction to this earnings report was so interesting, because this is, I've called it a weapon that management can use against basically the stock market, is if the stock keeps falling, hey, we'll just buy back our own stock. The other thing I don't think is getting enough credit for MGM is the Japan resort that they're going to be opening in 2030. Now, this is one of those things where if you are a long-term investor like I am, and you can think out to 2030, out 10 years from now, and what the operations of that resort are going to look like, you could be very bullish on it. If you're looking at what's going to happen next quarter, it's going to be really hard to think about 2030 and the impact of Japan, because it's just going to be negative cash flow over the next 6 years in particular. But this is kind of the timeline. They're going to actually break ground on construction in 2025, and then they're still expecting a grand opening here in 2030. So what are the financials going to look like? They're going to own 40% of that resort. Don't know exactly what the outcome is going to be, but the last time we had one of these major resorts opening up, that was in Singapore. That was Las Vegas Sands, and Marina Bay Sands happened to be the most profitable hotel and casino ever built in the world. This is another very wealthy area, another area where people like to gamble. It is very possible that MGM's take, or EBITDA, their portion of the EBITDA from this resort, is going to be around $1 billion. I don't think that's out of question, given the potential market size here. So could be another massive impact on the company that I don't think is really priced into the stock at this point. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. There was also a lot of talk on the conference call about the company's digital operations. So that's going to be BetMGM, and then also Leo Vegas. That's a company that they acquired, and they're starting to spread that all around the world. They can actually use the BetMGM name in other parts of the world besides the US, even though they only own 50% of that joint venture in the US. But the numbers right now, the portion of the company's operating losses for BetMGM for the last 3 months, $38.4 million. So management was expecting that to move towards profitability in 2024. Seems like that's going to be kind of pushed back. So there's a lot of questions on the conference call is, hey, are you going to need to invest more money in these digital operations? Are you just throwing good money after bad? What's the future of this Entain partnership? Not a lot of great answers, and this is one of the reasons that I want to focus on the physical operations for MGM, because I think that alone is a good enough reason to buy the stock and be bullish on the stock. And I look at these digital operations, and any potential growth or cash flow that comes from them is pure upside. We're basically not paying for that as investors. So any positives that come out of it is going to be good. I think management did kind of indicate that they've gotten to the point where they're sick of putting money into these digital operations, so they're not going to be doing that indefinitely, but they do see it as a strategic benefit because you're going to be able to bring customers in. You have a physical location, unlike some of the other competitors like FanDuel, like DraftKings. So there's a reason to have the business, but it's not necessarily going to be a revenue or profit center for the foreseeable future. So that's at least the way that I'm thinking about the digital operations that got a lot of focus yesterday. The other one that came out of the conference call, and I saw at least some investors being a little bit worried about, was comments about the Formula One race that's going to be happening later this year. And management said that the room rates that they're getting for that Formula One race are not nearly as high as they were a year ago. I think the number was even as much as 50% lower than a year ago. We need to put that into a bit of context. A year ago, a regular hotel room on the Las Vegas Strip was $1,000 a night. So to think that that's going to happen every single year during the Formula One race, I think is a little bit unreasonable. So there's going to be that pop from that inaugural race. It's still going to be a phenomenal weekend for Las Vegas, for MGM Resorts, but it's maybe not going to be the huge weekend that it was a year ago. There's also not going to be as much disruption as there was a year ago because they've done this before. So I don't think that kind of comment is a reason to sell off a stock 13%, but outside of the Formula One comments and the potential that the digital business is not going to be profitable in 2024 and it's a little bit unknown in the future, I don't really see a reason for the sell-off at all. Results were really good. Management's buying back stock. The other thing is that management was really bullish on growing their free cash flow in the mid-teens range through 2028. So as good a value as the stock is right now, they think they can grow it in the mid-teens range. This is the quote from CFO Jonathan Hawkyard. I'll continue my remarks with their algorithm, as they're calling it, enables us to achieve a mid-teens free cash flow per share compound annual growth rate through 2028. Simply put, we expect to grow our EBITDA at a faster pace than our rent escalators. Those are about between 1 and 3%. Interest payments, maintenance capital, and taxes while investing for growth and reducing our share count. That is exactly what you want to hear from a management team. That's the kind of performance that you want to see as a long-term investor. And given the valuation of the stock, I think this is a phenomenal buy in the market. And the stock market has gotten the reaction to this quarterly report wrong. But what do you think? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.